honestly, most people lose money in stocks. If you don't want to fall into that statistic, you have to know what to watch out for. 5 of the most common culprits of stock market failure and how to overcome each, coming up. Hey, how are you? It's good to see you. Once again, we continue on our quest to help you build out your rapidly growing, highly diversified net worth, and we're doing it one video at a time. Investors make mistakes in the market all the time. That's one of the reasons there are opportunities for us to generate outsized returns. In this video, we're covering 5 of the worst and most common mistakes. And I bet, even if you've watched other videos like this, you haven't heard number 5 before. If you aren't prepared for these, you should not have money in the market. It's that serious. And if you haven't already seen the deep dive video into the number 1 mistake all investors make, you should make a note to check it out after this one. Because if you don't avoid that huge mistake, you'll be helpless against these 5. Massive mistake number 1 is that most investors panic. Everybody panic! When you really think about it, on the whole, most of the time the market moves predictably. It's relatively sideways, often with an upward slant. And because that's all that's happening most of the time, at least for the last several decades, that's what we come to expect. After even a decade, we forget that markets go down too. Not in theory. I mean, we admit that it happens, right? Obviously, markets come down. You know that. We all know that. But in practice, we don't actually know or remember how that feels. So we're not prepared. And because it happens relatively rarely, we don't know how to prepare. But when it does happen, when the market does fall, it can fall fast and hard. And even though that may only happen once every decade or so, each crash unpredictable and different than the last, that's normal and should be expected. Now, here's something that other financial experts won't say. I'm not going to tell you blindly that you're wrong to panic. If you don't know why you're invested the way that you are, you don't understand the reason you have each of your underlying investments, you didn't initially invest preparing specifically for the possibility of a crash, then maybe you should panic. Maybe you should pull your money out of the market. In fact, if that's the case, you probably should right now and invest some time in understanding why you're invested the way that you are and in creating an investment plan that is prepared come what may. That's one of my goals with this channel, to give you everything you'll need to get there. So if that's your goal too, and you haven't already, consider subscribing. Also, if you want to supplement my videos here, you can check out the free course on the subject at Spicer Capital University. It's 4 hours of video content will help you overcome this huge mistake. Ideally, you want to be in a position of investment confidence, as everyone else who isn't subscribed to this channel is panicking. You can observe the chaos with a cool head. Panic! Because it's during that inevitable chaos that we're going to find some of our best opportunities to outperform. But that's an exciting subject for another time. Massive mistake number 2 is that most investors succumb to euphoria, also known as herd mentality. This one is similar to the first in that it's driven by our emotions. As we see others profiting from a market climb, it's hard to stay on the sidelines. Even when we don't understand or when we entirely disagree with the investment premise, a lot of people still jump in. In fact, it's the most disciplined investors who will actually suffer more. Carl Richards in The Behavior Gap explains, the terrible irony in this is that the people who are trying the hardest to stick to their plans, the ones who hold out the longest before they finally capitulate, are the ones who end up getting hurt the worst, because they buy nearest the peak. Once those hardcore holdouts give in, you know the top can't be far away, because there is no one left to buy. And in my mini book, Stop Investing Like They Tell You, I posit that the opposite is also true. As markets freefall, it's the disciplined investors who hold out the longest and suffer the most prior to their ultimate capitulation. This euphoria panic combination has historically knocked out countless investors. The third common mistake is trading too frequently. Now, if you're a day trader, this mistake becomes trading on emotion instead of your established set rules. But the negative effect on your long-term returns is the same. I have a longer time horizon than a day trader, and most investors do as well, or should as well. But when you become consumed by short-term fluctuations, that's when you're going to underperform. Not only will you underperform, but you'll lose more and more money to commissions, which is a major subject of our video exploring your personal broker options and my top recommendations, which I'll link to in the description below. Once again, you see your emotions working against you here. The solution is to have a plan before you enter each and every position. Based on what you know, play out every possible scenario in your head. In his interview with Colm O'Shea in Hedge Fund Market Wizards, Jack Schwager summarizes. O'Shea views his trading ideas as hypotheses. He defines the price point that would invalidate his hypothesis before he makes a trade, and he then has no reluctance on liquidating that position. Almost nobody does this, and we could do an entire video series on this practice and how you can do it and why it's such a good idea. And if you're interested, let me know in the comments. But the bottom line is that investors who trade on emotion, which happens when you don't prepare for it ahead of time and worry too much about short-term moves, end up making a lot of expensive, bad decisions. The fourth big mistake is getting emotionally attached to a stock. I've actually heard some industry authorities recommend you invest in companies based on your emotional attachments to them, and that is the complete opposite of what you should do.
That was terrible advice. Terrible advice.
That is dangerous. Emotions have no place in investing. That's what makes it difficult, because we are emotional and instinctual creatures by nature. But as you watch my videos or do any deeper research into the subject yourself, it becomes obvious that human emotion in some way is the primary force impeding most people's investment success. Before you make the decision to transfer your money from cash into the stock of a company or whatever, you need to have analyzed that investment and have a plan. You need to have rules in place, and then you just need the discipline required to stick to that rules. But if you don't, if you decide to skip all that, if you just take a position because you like it or some other emotion-driven reason, you probably shouldn't be trading on your own. And that's okay. You shouldn't feel like you have to. Now, that process I just outlined of emotionally evaluating each trade before it's made, it's deep and more advanced, but it's pretty imperative to lasting investment success. So you can bet that on this channel, we'll dissect every aspect of that further to make it really easy for you to follow and thrive. Investment mistake number 5 is that most people are actually speculating when they think they're investing. If you don't fully understand why you're invested in a certain way, you might be a speculator. If you don't know when you plan to get out, you're just playing it by ear, you might be a speculator. If you heard a good idea, didn't have time to research it, but took a position just in case so that you didn't miss anything, you might be a speculator. If you just liked the prospects of a company's product, so you bought some shares, you might be a speculator. If you haven't completed your own analysis of the company's financials, or you have no basis for any reasonable assessment of a fair value, you are speculating. Far too many individual stockholders in the market have never gone through any sort of formal analytical process to come to an educated decision about the investment they're considering. If that's the case, at best, you're speculating. At worst, you're gambling. Both can be disastrous long term, especially when you don't realize that that's what you're doing. I put together a short video series explaining the differences between investing, trading, speculating, and gambling, what they are, how to know what you're doing, and when each of them is appropriate. Now, I'll link to it in the description, and I'll put it in the card up there. If you're watching this video somewhere that you can see the cards, just click the I. Especially if you hold individual stocks or would like to, you should check that out. And if you'd like to learn more about that analytical process I talked about, at the end of this video and in the description, I'll link to a playlist that I'm building for you on fundamental analysis. And of course, stay tuned because we'll definitely be covering that more over time here on this channel. Now I want to hear from you. We just covered 5 of the countless mistakes new investors make. What are some others you've seen or experienced yourself? Let me know in the comments. If this was helpful, as always, let me know with a like and a comment, and think about who else this might benefit and share this video with them. If this is your first time joining us, I hope you'll subscribe, click that notification bell, and start your journey to building your rapidly growing, highly diversified net worth, one video at a time. As promised, here's that playlist for you and another video that might help you on your way. I'll see you in one of those. Take care.